Students, welcome to my class. In my today's class, we shall see to what extent cash flows gets differentiated based on different point of view. So keeping this in mind, we have tried to understand the cash flows, meaning net cash flows relating to three different point of view. One is the equity point of view, the other one is a long-term fund point of view, and the third one is a total resources point of view. So explicit cost fund point of view, we are not going to discuss over here. Cash flows, again, when I say cash flows means net cash flows. Net cash flows is equal to initial investment, operating cash flows and terminal cash flows. So these three important points or components will have to be there for us to calculate the net cash flows. So from the equity point of view, when I say initial investment, it is money that you have generated by issuing the equity funds or equity shares. Operating cash flow, when I say, it is profit after tax minus preference dividend, add to that the depreciation plus any other non-cash charges. When we take terminal cash flow here means net salvage value, the amount left with us at the end of the life of the asset, net salvage value of the fixed asset plus a net salvage value of the current asset minus a repayment of the term loan minus a redemption of the preference share capital, minus repayment of the working capital advances, and minus a retirement of the trade credit. Retirement of trade credit is basically the amount that is due to the suppliers and that requires to be paid off at the last phase of the project. Okay, that is what is retirement of the trade credit and other dues. From the point of view of long-term funds, when I say net cash flows, again it means initial investment, operating cash flow and terminal cash flow. But since we have long-term funds here, any amount of long-term fund that is invested in the project is what is initial investment, which will be equal to fixed asset plus working capital or equity plus long-term loan. Profit that we have, see, the amount that is left after tax plus depreciation plus other non-cash charges plus interest on long-term borrowing after deducting the tax. So when we say operating cash flows, it is after tax plus depreciation plus non-cash charges plus interest on long-term fund. Because we have long-term fund here. That's the only difference here. Okay, which is only after tax rate. 1 minus T we have to take. And terminal cash flow here means net salvage value of fixed asset plus net recovery, or we can also say net salvage value of the current asset, which is working capital margin. And from the point of view of the cash flows relating to the total fund, initial investment means any amount that is invested into the project, no matter whether it is short term, long term, whatever. So this is nothing but your total outlay, the total amount of money that is invested into the project, which means it is total capital that is invested in the project, which should comprise of both the fixed asset as well as the current asset. Operating cash flow, when I say, it is profit after tax plus depreciation plus non-cash charges plus interest on long-term funds, 1 minus the tax rate, interest on short-term borrowings, which is 1 minus the tax rate, right? And again, when we have the terminal cash flow here is salvage value of the fixed assets plus the salvage value of the current asset. You have to just understand this one portion of it to know the meaning of cash flows. Okay, this is the first important step. Now, keeping this in mind, let's go to a question. I've taken up a question. Magnum Technologies Limited is evaluating an electronic project for which the following information has been assembled. I've already shown in the classroom as to how the facts of the case will have to be written. So I will not be able to show that in the video now. But however, considering the request, let me show you how it is taken. The total outlay of the project is how much? 50 million. This consists of 30 million of fixed assets and 20 million of current asset. The total outlay is 50 million, which is this 50 million, however, is taken. They have tried to collect the fund in these forms. One is by issuing the equity, which is close to around 15 million, 20 million. They're going to raise a term loan of 20 million and they're going to raise a capital, working capital from some bank. which is close to around 10, and 5 million of trade credit. So if you just put this across, 15, 20, 10 and 5 will be equal to 50. So this is the various sources of fund. The term loan is repayable in 5 equal installments of rupees 4 each. 4 million each. What does that mean? The amount that you have taken. Where is a term loan? 20 million is a term loan. This 20 million will have to be repaid in 5 equal installments, which means 20 divided by 5, 4 million each you have to repay. The first installment will be due at the end of the first year. Yeah, and the last installment at the end of the 5th year. So which means after the end of the first year, you're going to repay 4 and it goes on, and the last installment will be done at the end of the 5th year. However, there is a working capital that you have raised by the help of bank, yeah, and trade credit also, which will remain at 10 and 5 till they are paid back, in the sense that they'll continue till the life of the project. So at the end of the 5th year alone, they will be paid back. That's what is the meaning of it. So the interest, if any, in any case will have to be considered. It depends upon the point of view here. The interest rate on the term loan and the bank finance is 10% and 12%. The expected, this is known to us. Okay, so on term loan it is 10%, whereas what you have taken from the bank as working capital is 12%. Revenue from the project is 60 million. The operating cost excluding the depreciation is 42 million, and the depreciation is on the fixed asset, which is depreciated at 15% on the WDV method, which is the diminishing balance method. The net salvage value of the fixed assets and the current asset at the end of the 5th year will be 5 million and 20 million. So which means this is the total value that you're realizing out of the fixed asset and the current asset at the end of the 5th year, which is to be taken under your terminal cash flow. Tax rate is 30%. Now, they've asked you to find out or define the cash flows from the equity point of view, the long-term fund point of view, and the total resources point of view. Like I said, in the class, I have shown you the facts of the case. You can refer to that, but due to the time, I will not be able to shoot the entire thing here. Okay, let's quickly take, how do we take the amount that is invested initially, which means we are talking about what? The initial investment. I very clearly told you, when I say cash flow, cash flow, it is net cash flow. When I say net cash flow, it is nothing but initial investment. Let me put this properly here. When I say it is initial investment plus operating cash flows plus terminal cash flow. Okay, this is something that you have to remember. So the first part, we are going to understand what is the initial investment from all the points of view. So from the point of view of equity, now equity, it means only that money that is invested in equity. Okay, which means it is 15 million. How did we get this? Look at this. 15 million. That's all we have taken. Okay, from the point of view of long-term fund, it is equity plus long-term loan. So 15 and long-term loan is 20, which is 35. This is the meaning of it. Okay, you can refer to your formula. The total resources is nothing but your total fund point of view, which means it is a total outlay in whatever form they have come to you. They have come to you in some part which will help you make your investment into the project, which is close to around what? This is what it is. So 15 plus 20 plus 10 plus 5, which is equal to 50 million. All of them has been taken here. Okay, all these are taken here. So this is the initial investment. The second part, okay, let me not go to that. The second part is the operating cash flows. This is the part. If I have to calculate the operating cash flow, first of all, I have to understand to what extent I will get earnings after taxation, because we are roughly given the components of income statement, which will by and large help you understand what is the earnings after taxation. So quickly let us understand this portion, and then we will try to define it based on the equity point of view and other points of view. Okay, now what is it we are going to do here? Earnings. Our objective here is not to work out earnings after taxation, but to make all adjustments connected to this earnings after taxation to fit the definition of operating cash flow from different point of view. Okay. Now in this context, let's understand in the books of Magnum Technologies Limited, we are preparing the income statement for the proposed project amount in rupees. So we have to take 1, 2, 3, 4, 5, or you may start with 0. That's okay. So you may take 1, 2, 3, 4, 5. Revenue. How much is the revenue that you have made? Revenue made during the year is 60. The operating cost is 42. Depreciation is 15%. Let's take that. Okay, I'm little fast here. Please refer to your notes. Revenue is 60, 60, 60 and 60. Operating cost is how much? 42, 42, 42, 42 and 42. Depreciation. Depreciation is one of the maintenance expenses. Okay, so therefore we have taken this one step before the financial expense. This interest on working capital advance is a financial expense, whereas your depreciation is your maintenance expense. In your class, I have already told you, in calculating the operating expenses, we should consider the administration expenses, the maintenance expenses, the financial expenses, and then the selling and distribution expenses. So we have placed them in the order. Okay. So what is that we have taken here is the depreciation. How did we get the depreciation? A total depreciation is the 15% is a total depreciation. Where is it? Yeah, 15% is a total depreciation. Now 15% of your asset 30. So 15% of 30 is how much? 4.5. Yeah, maybe I'll write it here. 15 minus 4.5. You'll have to find out how much is it. Okay, it is 10.5. Again, find out what is 15% of it. Okay, so 15% of 15 is 4.5. Then 15 minus 4.5, 10.5 into, again, 15% of it. You have to find out. Okay, that way if you calculate, you'll get 3.825. Okay, 3.83, 3.25, 2.76 and 2.35 is the answer. Okay, that is the depreciation. We also have the interest that is calculated on the working capital. Now, what is the total working capital? Now, total working capital is around how much? 10 million. 10 million, the rate of interest is 10%. So 10 into 10%. How much is it? 1.2, right? So, 10 into 12%. It's 10 into 12%, which is 1.2%. Okay, so 1.2. So I've taken 1.2 everywhere. Then there is also interest. So this is at the rate of, let me write it. This is at the rate of 12% and this is at the rate of, this is at the rate of 10%. Yeah, that's what is written. So we have taken. How did we get this to? Now see, the total amount that you have taken as loan is 20. 20 into 10 by 100 is 2. But at the end of the year, it is getting repaid. Correct. So, which means, let me take this for you. 2, how did we get? It is 20 minus 10% of it. Okay. Now, out of this, 5 is repaid. So, how much is left? 15. So, again, you take 10% of it. How much will you get? It's not 5. I'm sorry. It is 5 equal installments with 4 each. So, it is 16. Right? So, 16 into 10%. So, 1.6 and it goes on. So, from 16 again minus 4, you get 12. 12 into 10 by 100, it is 1.2, 0. It goes on. So, EBT is 10.3 and 14.05. Tax is at the rate of 30%, which you get after. So tax on this will be 3.09 and it goes on till 4.22, and earnings after taxation is 7.21. Now what did we do here?